Good afternoon, friends. I'm Sandeep Biyani, heading business development and sales for Alpha Credit Advisors. Welcome to Alpha Credit Advisors AAA Investor Connect. In our last webinar, looking beyond the dark clouds, we talked about global scenario of Russia-Ukraine war, increasing interest rates and inflation globally, and how India as an economy as well as Indian equity markets reacting to all these changes. These dark clouds of global uncertainty are still there. But as we all know, every dark cloud has a silver lining. In the same way, market too presenting some great opportunities in these challenging times. Today, we are focusing on identifying those silver linings. To present this, I would like to invite our founder and managing director, Mr. Rajesh Kothari. Welcome, Rajesh.
Thank you, Sandeep. Thank you very much.
Yeah, Rajesh, in fact, as I'm saying, there are many new attendees in this call, or many are listening to you for the very first time. For their benefit, I would like to request you, please throw some light on AAA's investment philosophy, briefly a bit, and then you can take on the topic of the day. Thank you. Over to you, Rajesh.
Perfect. Thank you, Sandeep. Good afternoon, ladies and gentlemen. Warm welcome to AAA Invest Connect program. As Sandeep has said, let me do one thing. Let me very briefly, maybe for about 4 to 5 minutes, talk about our investment philosophy, our approach, and then we'll move to the topic of the day, particularly in this kind of environment. What should be the investment strategy? What we are doing here? How do we see the future in the short term and medium term? And last but not least, how we see the corporate earnings growth of our portfolio. Let me share with you one screen of the presentation. I hope this screen is visible to all of you. Sandeep, this screen is visible, I hope.
Yeah.
Perfect. Thank you. So friends, as you know, most of you are aware, this is Alpha Credit Advisors. The few important differentiation of Alpha Credit Advisors is founders are fund managers. There is no conflict of interest. We are not into any other business like broking or wealth management. 100% skin in the game. Very high level of corporate governance. One of the few firms with a vintage of 13 years. And of course, in last 13 years, we have delivered superior risk-adjusted returns, award-winning track record. We have delivered roughly about 19% compounded returns, almost 9 times money in 13 years. And we have the best of the investor services. Our consistent performance is rewarded and recognized by many institutions like PMS AIF World. We got top 3 ranking for 2 consecutive years. This year, we received the award for the best PMS provider in India by APEC, UK-based publication. And of course, Silicon India also rated as one of the top 10 most promising PMS in the country. What is our investment philosophy? Our investment philosophy is all about how can we protect capital and then create wealth. It is not just about the wealth creation, but it is about protection of capital, particularly during the times when the drawdowns are very high. What we ensure is that how can we fall less than the market? And of course, when markets are doing well, our entire focus is how can we create more wealth? How do we protect capital? 3 important things: DST approach, diversification, staggered investment approach, basically no model portfolio, and last but not least, important, very important for all, is a defined exit strategy. We believe that beyond a point, it is extremely difficult to predict governance. It is extremely difficult to predict technology. It is extremely difficult to predict business cycle. Our diversification across stocks, across sectors, and across market cap helps us to navigate such incidents, to absorb such shocks if it happens in our portfolio. No model portfolio, staggered approach, it ensures that it is always a forward-looking portfolio, unlike the backward-looking portfolio. An exit strategy is something very, very important USP about Alpha Credit Advisors, because we always believe that only constant is change. And if your portfolio is not aligned to the change in the trends, then that portfolio may not perform in the long term. How do we create wealth? We have a very simple but very unique and importantly, very effective approach called 3M investment approach: market size, market share, and margin of safety. We invest in the companies where the size of opportunity is huge, so that if we go right, we make exponential returns. But very importantly, we invest only in those companies which are leaders in their respective sectors. By buying the companies which are leaders in their industry, it makes sure that we navigate the companies being leader, they navigate downturn and upturn of the business cycle very smoothly. And last but not least is the margin of safety. We are very conscious about at what valuations we are buying these businesses. Once the company is selected based on our 3M investment approach, definitely it has to be backed by best of the management, best of the governance, and of course, best of the financials. All our portfolios across the different products, most of our portfolio companies, they are debt-free. There is zero leverage. There were no debt, no loans on the balance sheet. They all are large companies by market share. They all are large companies by revenue. They are large companies by the profit size. And that is something very, very important. It is a deadly combination of best of the management with the best of the market share and very importantly, with a zero debt balance sheet. But we do not stop there. On top of it, we make sure that the portfolio is a very strong earnings growth. And that combination of good earnings growth with the efficient balance sheet, it results into very high return on capital employed. It is our that strategy which helped us to deliver the consistent performance across our 3 PMS plans during last 13 years of our journey. Our AAA India Opportunity PMS plan has delivered 18.4% compounded returns compared to benchmark returns of 11.9. Our Focus PMS plan has delivered 14.4% compounded annualized returns since last almost 7 years compared to benchmark returns of 11.9. And our recently launched, roughly 1.5-year-old product, AAA Emerging Giants, has delivered 30.2% returns compared to benchmark returns of 26.4. Our IOP PMS has a track record of almost 13 years. Our Focus PMS plan, 30 stocks portfolio, primarily large cap and mid cap, has a track record of now 7 years. And our AAA Emerging Giants, mainly mid cap and small cap, has a track record of now almost like 17 months since its inception. This is how basically we make sure that our performance is consistent, deliver alpha with a focus on taking the as much less risk as possible. With that, let me move to the topic of the day, spotting the opportunities, spotting the silver lines. Friends, to give you some background, I'm just putting one slide, which I was there, that slide was presented even during last presentation, the story, the chain of events which has happened in last 2.5 years. Very important to keep this in background. That in March 20, the Fed was supportive. It printed money, resulted into better economic growth. But then Russia-Ukraine resulted into the significantly higher commodity price. Higher commodity price, along with the supply chain bottlenecks, resulted into hyperinflation. And that hyperinflation forced Fed to increase the Fed rate significantly from almost 0% to right now raising rate to 3.25% from just 0.25 in March 2022. So as I speak, the US Fed has already increased its target range to 3 to 3.25, significantly high interest rates. And that high interest rates results into the fear of GDP growth slowing down significantly and resulting into whether the world will enter into recession. And if yes, probably yes, but what kind of recession is going to be? Is it going to be deep recession or it is going to be mild recession? And of course, those fears results into global indices, particularly Dow Jones and S&P 500. They all are down by almost 25 to 30% in US market. So there is a panic across the world market. In that story of chain of events, there is very important thing to understand from investors' perspective that the regime has changed. Last 10, 20 years, particularly from 2008, almost I would say 13 years plus, the US was having almost zero inflation and almost zero interest rates. From there, right now, US inflation is running hot at almost 8% plus, and interest rates are almost 3% plus. One thing is sure, that next at least 2, 3, 4, 5 years is not going to be zero inflation and zero interest rates. It is going to be high inflation and high interest rate. And in that backdrop, the market will not remain low volatile. Volatility will increase, market will remain very, very volatile. As I speak from last, I think if I'm not wrong, from last 4 webinars, I've been talking about it, that we believe the market is to remain volatile. And we do not see any change in that assumption. But there is a silver line. And what is that silver line? Look at the commodity prices. I put 10 commodity prices here. Brent crude from peak prices is down 37%. If you look at the natural gas, down by 32%. Aluminium down by 45%. Copper down by 29%. Zinc down by 33%. Corn and wheat, soft commodities, are also down by 18 and 31% respectively. China steel down 38%. Coking coal down 31%. And lead indicator price are also down by 25%. The moral of the story, there has been sharp reduction in the commodity prices from its peak levels. And because of reduced commodity prices, inflation is also likely to cool down after a couple of quarters, maybe by June quarter or so. But good thing is that silver lining in the dark cloud is that commodity prices have started cooling down significantly. I'm marking my word, underlying the word significant. It is not 5% drop. I'm talking about 30 to 40% decline in commodity prices. What is happening to the supply chain? The supply chain was considered as one of the most important factor in making inflation 8% for US citizen. So what supply chain mein kya ho raha hai? That supply chain is easing significantly. If you look at this index, it was more than 4 in September 21, December 21. Again, it was more than 3 during Russia-Ukraine war. Right now, as I speak with you, it is almost now below 2. It is now probably going even below 1.5. This is something very, very important. The decline in this index, it means the manufacturers are facing less pressures from the consumers, and that is resulting into supply chain becoming normal. And if you look at even the freight index, the freight index are also down by 30, 40, 50, 60%. And if you hear the many global corporates, like for example, semiconductor companies, they are talking about a easing supply chain as we move forward over next couple of quarters. But then, do you think market can go down significantly? That's the question in everybody's mind. Kya bazaar ye level se kitna niche ja sakta hai? And here, I would like to give a very important chart in front of you. Markets are always forward-looking. We all know about this, but let's look at data of last 40 years. What has happened in last 40 years? Look at this chart very carefully. In last 40 years, there were 2 years where US GDP was negative. Recession in US. Everybody's asking us, am I right? Do you think US will enter into recession? And if yes, what will happen to the market? In last 40 years, there are 2 years. In 2009 and 1982, the GDP became negative. It means recession in US market. But in both these years, S&P 500 went up. I repeat, S&P 500 went up. Bazaar upar gaya 15%. Market went up by 15%. Market ऊपर क्यों गया 15%? क्योंकि वहां पे तो recession आ गया. Because markets are always forward looking. Today, the word recession, everybody talks about. If you look at Google, is the most searched word in the world. So when everybody, you, the retail investor, the non-investor, Ola guys, Uber guys, when all of us talk about recession, markets are very smart, markets are very efficient, and most of the recession fear, in our view, is already priced in. And that's the history is also telling you that in a year of recession, markets actually go up rather than going down. But then the silver line is India. Why India is doing better? Everybody has a question. कि sir India क्यों नीचे नहीं जा रहा है? The reasons are obvious. First, very important reason. What is our inflation? 7%. What was our 10-year average last 10 years? Just 5.5%. It is not like US, 0 versus 8. It is 7 versus 5.4. What is our currency depreciation? And I will talk about it in a moment. Look at our current account deficit. FY13 May, it used to be 5%. Right now, it is just 2.4. It is manageable. Look at our forex reserves. It is double than 2009 collapse. And look at our import cover is almost 9 months of import cover. So yes, can India be completely isolated? Not possible. World is one. Whether there will be impact on India growth also? Definitely yes. But India is in a much better situation compared to any other country probably in the world because our macros are much better position compared to where it used to be about 10-15 years back. Let me show you this in very important chart is a currency chart because currency tells you actual health of the economy. How good the economy is, how good and strong is the country's health is reflected in its currency. Most of this currency, you look at yen, you look at pound, look at South Korean currency, look at euro, most of these currencies are down 20% or so. But look at India. We are down roughly about 9.4%. Is it a great news for us? I think so. Because considering the collapse in the global economy, considering the collapse in global equity markets, our 9% depreciation in currency is much better than most other countries. Not only it is much better than other countries, our own experience of last 70 years, this time we have done much better. It is a truly resilient India compared to most other economies in the world. But then the question comes, why it is so resilient? And what is the silver lining in this kind of a dark clouds globally? Let's look reality. First, the manufacturing sector. Look at the PMI, pre-COVID. I'm not talking about last 1 year. I'm not talking about last 2 years. I'm talking about a year when there was no COVID. Our manufacturing PMI was 51.4. And where are we today? We have not only become normal, but it is 55 plus. We are higher than pre-COVID manufacturing PMI. What is our GST collections? 17% compounded growth. If anybody asks you, what is your view on Indian economy? The single most important barometer for you to check health of Indian economy, forget markets for a moment, is to look at the GST collection. And sir, despite 2 years of COVID, despite the pandemic crisis, we have done 17% compounded annualized growth in GST collection for 3 years. I must say this is a congratulatory job for our country, 17% by any means. For a country like India, which passed through the crisis of pandemic and also passed through the difficult supply chain index, the Russia-Ukraine war, the crude oil volatility, and of course, right now, the global collapse because of recession, 17%. It has never happened in India before when the world was passing through such a gloomy environment. And look at the bank credit growth. You look at 2013, this for the first time since 2013, our total credit growth at bank level is now 16%, first time in 9 years. What does it mean? It tells you two things. One, bankers are ready to lend, which was not the case in last 6 years. Bankers are very, very skeptical. Underlying assets were the most important thing. Risk management was the priority. Borrowers' balance sheets are fractured and they were not willing to take the risk. Today, bankers are willing to take the risk because their balance sheets are cleaned up. And secondly, the borrower is ready to take the loans. Very important again. Till now, the borrowers were also very, very conservative. They were not too sure about India growth. They were not too sure about domestic growth. They were not too sure about exports growth. But because the Indian economy has done so well, because there are a lot of opportunities because of the PLI opportunities, the China plus one opportunities, Indian corporates are now willing to borrow more for the further expansion and for the future growth. And therefore, for the first time, non-food credit growth is significantly stronger and total credit growth has touched 16%. These are really spotting the silver linings. Today, the entire world is looking at India because the GST collection is robust and the manufacturing PMI is improving and the bank credit growth has become double digit. Is a rare combination for a country like India. It reminds me of my time in 2003, 2008 period. During that time I was with DSP BlackRock, and I still remember that how the country's manufacturing PMI, the industry IIP growth, and the bank credit growth used to be so strong that it resulted into market delivering 5 times returns in 5 years. And I hope we are probably entering similar zone in economic terms. I don't know about the markets, but the corporate India, the resurgence of corporate India and the Indian consumer, that combination is deadly. I'm sure many of you would have read today's Economic Times, and the luxury vehicle sales is the highest. World is talking about recession, and in India, highest number of cars are getting sold. That too, I'm talking about Mercedes-Benz. That tells you about what is happening on ground in Indian economy. I'm talking about listed space. I'm not talking about SME and the rural India pain. Important thing which is also comes to our mind that last 3 years, if you remember in our one of the 2020 early webinar, we talked about very important theme called China Plus One. After a very long time, probably nobody thought that it can also become Europe Plus One. In Europe, the energy prices are going through the roof. I'm sure many of you are aware that the gas prices have increased multifold from just $3 per MMBTU to almost $70, $70 currently, from 3 to 70, 25 times, 20 times increase in natural gas prices. That makes many European players, many European industries unviable, because at that kind of a cost, it is not possible for European companies to make the business viable to serve to the customer at the right cost. We believe it is a golden opportunity for corporate India. And when we further analyze this opportunity, there are 3 buckets where we can get the benefits. The first, the multinationals who already have presence in India. For them, it is a very easy job because they already have the infrastructure in country, and therefore for them it is just a one leg of expansion. And we are already seeing the trends of it, early signs of our companies. Many of our portfolio companies have already started getting orders. Say, for example, a company called Schneider Electric, one of our portfolio company in AAA emerging giants. That company has announced 2.5 times, 2.5 times increase in capacity for the first time, and that too to cater to their parent company. Schaeffler, another company in our portfolio, the global company decided to close few lines and shift that entire thing to India. This company is doing capital expenditure of close to 1,000 crores, again, primarily to meet their parent company requirements. Timken, I'm sure many of you are our existing investors, and they know that Timken has been a multi-bagger for a portfolio. We are holding from almost like last 6, 7, 8 years. This company has continued its expansion plan to mark its presence on the world map from exports perspective. And Cummins, one of our company again in our across portfolios, they are seeing that the Cummins India products, because our emission norms have changed and it has become so efficient that now our products can be exported to North American market, they can be exported to the Europe market, they can be exported to the world markets. So multinationals with a presence in India, definitely they have a natural advantage. Second bucket, which will get huge benefit, is the Indian companies who are already exporting to the global customers, particularly specialty chemical space, particularly auto ancillary space, and companies like that. These are the set of companies, they already have the best of the plants, they already have the customer approvals for their manufacturing facilities, and they already are currently ramping up more for their existing customer. Now, what happens when existing customer is sourcing from the vendor who is approved, and if one of my arm, the Europe, the manufacturing side is not working well due to whatever reasons, the obvious choice for me is to ramp up from my other vendor, and Indian company comes very handy. Many of our companies are doing huge capital expenditure equivalent to their gross block. For example, SRF is a classic example, which is spending almost 12,000 crores, which is equivalent to their gross block, and that too over just next 3 to 4 years. So this is a second bucket which is going to get benefit. Specialty chemical, auto ancillary comes in this bucket. And the third bucket is the companies in India, but they have a huge domestic base. Therefore, they have a natural economies of scale advantage. And now they are looking at the global markets to make their presence felt. For example, there is a company called Minda Industries. I'm sure many of you would be knowing this company. This company has this revenue has grown 8 times in 10 years, and profit has grown 10 times in 10 years. And this company is now eyeing the global market for their switch business. And likewise, there are many other such companies which are looking at exports as a base. This is another silver lining. So I'm just trying to give you few important, silver linings, which are opportunities for country like India. One is Europe plus one. Second is, of course, China plus one. Third is the resilience of India in terms of the currency, the falling commodity prices, particularly crude prices and energy prices. All these things are working currently in our favor. But then market has corrected. There are many investors during our meetings, one-on-one meetings or in the conference call. They keep asking us that, do you think market can correct by 20%? Answer is, of course, while nobody knows can market correct by 10% or 20% or 30%, who knows? But let me tell you, market has already corrected by more than 20%. And let me tell you how. If you look at March 2019 EPS, and if you look at the March 23 EPS, I'm talking about a Nifty EPS, the earnings have went up by 69%. Against that, if you plot the Nifty index, March 2019 and March 2000 and the current September 2022, Nifty is up only by 45%. I'm sure many of you are aware, time and again we say market is nothing but mirror of earnings growth. If EPS is up 15%, market has to go up 15%. If the EPS is up 25%, market has to go up 25%. In the long term, both these have to match. And I'm not giving example of March 2020 low of Nifty. No, I'm taking a base of March 2019, a normal year. From a normal year, EPS is up from 100 to 169, but Nifty from 100 is only 149. And therefore, there is a good gap of 25 plus rupees. So almost 18% is a discount. And that discount is basically nothing but correction. So anybody who says that market is right now at 17,000, I would like to tell them that it is not 17,000. Probably market is already 15,500 because there is a good time correction of last 12 months has happened despite earnings growth of 15% in last 12 months. And that is reflected in the valuation. Our March 2019 PE was 24 times. And currently we are trading at roughly 21 times. So whether you look at from the earnings perspective, whether you look at from the PE perspective, whether you look at the Nifty versus EPS perspective, there is a decent correction in the market which has already happened, may not be visible on price of it, but inherently the implied you are getting it at a discount. Valuations, we are below 10 years on price to earning basis. Again, telling you the same thing that market has not moved much in last 1.5 to 2 years. If you look at on the PE basis, again, I'm saying, and that again makes a case that that's a silver line, that the valuations are becoming attractive. There was a growth in the valuations about 9-10 months back. Today, those valuations have corrected, making it very, very suitable environment for the long-term investors to invest into Indian equities. In that backdrop, let me spend 5 minutes on how we are positioned. Friends, as you are aware, with 3M investment approach, we buy only market leaders, and our focus is always to buy and bet on the earnings growth. Wherever there is an earnings growth, we always look at the companies which will deliver 18, 20, 30% earnings growth over next 12 to 18 to 24 months. And therefore, our entire portfolio, if you look at it, they are on the top quartile of the earnings growth. And that is also reflected in our FY22 and FY23 earnings growth of 30% in FY22 compared to Nifty earnings growth, revenue growth of 24% plus. So we are always focused on earnings with the best of the companies and best of the management. And that's how we are positioned across our portfolios. We are focused on the strong earnings growth with a zero debt balance sheet and 18 to 20% underlying business return on capital employed. Few sectors on which we are bullish. I talked last time, nothing much has changed. I will just reiterate, what is our view on these sectors. We are positive on automobile. This stand we have been there from last, I would say from last almost 9-12 months, and we continue to remain positive. The commercial vehicle cycle, if you look at this chart, if it is visible to you, this was the peak, and we believe that we will probably cross that peak in FY24. So 6 years of consolidation. So we believe that a lot of things are going to happen on the CV side. Same is for passenger vehicles. We believe that passenger vehicle volumes are also going to go up. There was a semiconductor shortage issues which are getting sorted out, and right now there is a good waiting period for most of the good models, by whether it is a Maruti Suzuki or whether it is a Hyundai or any good model for that matter. There is a good waiting period, which tells you again that underlying demand is very strong, and therefore profit growth is going to be strong. One, the volume growth. Second, the raw material costs are coming down. Third, the semiconductor shortage is also improving. And because of these reasons, the discounts will narrow. And as the discounts narrow, the profitability will improve. And we are rightly positioned in automobile as well as auto ancillary sector. Second sector, which we were early in the game, we were in positive on this from almost like last 1.5 years, is the capex story. If you look at the central and state government, the capital expenditure is significantly focused upon. PLI further adds 4.4 lakh crore PLI-led capex over the next 4 to 5 years. And this is getting reflected in order inflow. So I'm not now making projection. These are the actual numbers. If you look at the order inflow, 53% growth in FY22, 446 billion, 44,000 crores order inflow compared to 31,000 in normal year. And of course, 2 years of compressed order inflow of 30,000 crore each in FY20 and FY21. When I talk about capex, we do not have any exposure to EPC company, irrigation company, power company, transmission company. We have zero exposure to these names. We are very, very positive on the companies which are technology as a mode, robotics, automation, process efficiency, and so on and so forth. So all our companies, their product portfolio is extremely robust. Very, very strong product portfolio. They are gaining benefit because of the short cycle nature of the order. For example, companies like ABB or companies like KSB Pump, the third largest pump manufacturing company in India. It is a German subsidiary. Or companies like Cummins, or companies like Timken, or companies like Schaeffler, and many more such companies. All these companies are multinational companies backed by strong parentage. They have a strong research and development. They have a strong technology as a mode, and they are getting their more and more orders, not only for domestic market, but also for exports market. Banking, we are positive, roughly about 27% of the portfolio is in banking. We believe that the asset quality, the worst is behind you. The credit cost is going to come down. And as I mentioned, the bank credit growth has already started improving. And that's the inflection point for banking. Of course, you need to be very, very selective when you select the banks. But overall, as a sector, we are reasonably positive on this need. And last but not least, one of our favorite sector, Indian specialty chemical. We have been positive on this theme almost from 2017. And we believe we are just at the beginning of the cycle. Probably it is a structural opportunity for next 4 to 5 years. Our market share compared to China is very, very low. We are just 33% compared to Chinese market. And I think opportunity is huge. 5% shift from China to India is enough for our portfolio companies to deliver earnings growth of 20 to 30% per annum for the next 4 to 5 years. So I think this space is going to be very, very interesting. Since we are talking about a specialty chemical, I'm sure many of you would have attended our special seminar on specialty chemical. You need to be very, very careful when we select the companies. We avoid the commodity chemicals and we focus only on those companies who have something specialty in their business model. Scale is very important. Backward integration and forward integration, the product purity, the research and developments, the patents, the cost competitiveness, and many other such factors that really makes it interesting for this sector to watch for. This sector presents enormous opportunities, and we are holding best of the companies. All are market leaders in their respective sector. For example, fluorine chemistry, we are holding #1 company in India, SRF, and #2 company in India is Navin Fluorine. We own both these companies. In ATBS segment, there is one company in the world which is 65% market share, and that company fortunately is based in India. The name of the company is Vinity Organics. We are holding from quite some time, and many more such companies which are largest players in their respective sector. They really spend a lot of time on R&D. For example, SRF spends roughly 100 crores a year on their research and development. Or companies like Navin Fluorine, they've got the process patent from a Honeywell, is the only company in Asia to get this process patent, and so on and so forth. So we believe that the opportunity is huge, and I think it can be very, very rewarding opportunity over the next 4 to 5 years. So that's our view on the various sectors. Just to summarize from the sectoral perspective, we like specialty chemical, we like capital goods, of course, where technology is a mode and not the commodity engineering company. We like banking and finance, uptick in credit growth is already visible. And we like automobile and auto ancillaries, where there is a scale and the natural benefit of improvement in the underlying business cycle. With that, I would like to close my presentation, and we will open up for Q&A. But before we open for Q&A, I'm thankful to all of you for joining on this webinar. I'm also thankful to all the partners and all the investors who have supported us in this journey of last 13 years. And it is a really beautiful journey. And I wish everyone, you and as well as your family members, a great Diwali and prosperous New Year. Please feel free to ask whatever questions you might have. We are open to opening up this session for Q&A. You can put your questions in the chat box, and feel free to put whatever doubts you might have. Thank you. Sandeep, you can take it forward.
Yeah. Participant, please post all your questions in the chat box, and we have collated a couple of questions we received from the participants. We'll take it one by one. And meanwhile, also I'm requesting all the participants, again, if you have any additional questions, please feel free to post on the chat box. Rajesh, there are a couple of questions, in fact, already came from the participants. One is, during last 3 to 5 years, many stocks in India did extremely well. India is always a stock-specific story, stock pickers market. What is your view on Indian equity in that context?
Wow, I think it's a really good question, and this is a question I think every fund manager loves to answer this question, because I think the question itself has an answer in it. India is always a stock-specific story, so we can spend n number of hours in debate, discussion, recession, inflation, interest rate, RBI, Fed, politics, many more things. But the fact of the matter is that there are 500 to 600 companies in India which have found a secret sauce of growing their businesses, doubling their businesses over next 4 to 5 years. And they keep doing it repeatedly. Let me give you one example, and that reminds me that, one of the investors also asked that a typical multi-bagger kind of a thing. There's a company called Trent, and I'm sure everybody knows this name. Everybody knows Trent by, the West Side. West Side is a 1.6 million square feet in March 2018. But in March 2022, in a matter of 4 years, Trent created another West Side of 1.8 million square feet. And that format is called studio format. Despite 2 years of COVID, despite Russia-Ukraine war, despite Fed doing whatever they want to do, the fact of the matter is that Trent has doubled its capacity at that scale, on that scale, doubling capacity, irrespective of what is happening to the world. And that's the opportunity what India offers you. I don't know about Indian economy growth. People ask us, what do you think about growth? And we go by RBI number. But what is important is that not economy. What is important is that the companies in which we are looking at it, are there enough opportunities? Whether there are 50, 100, 200 companies, can they scale up their businesses? Can they double their businesses in the next 4, 5, 6, 7 years? And if you can identify opportunities, if you can spot those opportunities, and if you play that right, then that the target returns of what we say to investors, good double-digit returns over a longer term, it is achievable. And there are many more such companies, and these are big names. Now, why for Trent it was possible? Because the unorganized market is probably 95% in apparel. Organized market is only 4%, 5%, 6%. So every year, Trent takes away market share from unorganized to organized. And that story, unorganized to organized, unbranded to branded, and likewise, that story is a huge story. It is not yet paid out. And irrespective of 5% GDP growth, Trent will continue to probably deliver 20% plus revenue growth over next 4, 5, 6 years. And that's how India is always a stock-specific market. And good part is, Sandeep, there are many opportunities, what we see. Even today, people asked us even 4 years back, don't you think Trent is expensive? And I said, no. And even today they ask us, don't you think Trent is expensive? I said, no. The reason is we believe Trent can continue to deliver 20-25% compounded revenue growth year after year, even from current levels. So I think, we have a huge opportunity. We need to spot the opportunities. We need to monitor those opportunities. And of course, we need to make sure that once we identify the opportunity, right time, of course, we also have to exit that opportunity. And I think that's what the beauty about India is all about.
That's great, Rajesh. In fact, another question from Mr. Amit Desai. How does rupee depreciation affect stock markets, especially IT sector?
Yes, the rupee depreciation has a two-side impact for stock market. One is the impact on the economy, and second is impact on the sectors. Now, on the impact of the economy, because the rupee depreciates, it creates pressures on your overall forex reserves, and also it creates pressure because we are an importer. We import the energy, and to that extent, it creates pressures on fiscal deficit. So, rupee as a depreciation of rupee as a, if you ask me on a standalone basis, depreciation of rupee has a negative impact on Indian economy. But it is also has, as every cloud has a silver line, it has also some positive impact. What is a positive impact? Currency depreciation makes Indian companies more competitive in the world market. But you don't have to see only on this picture. You have to also look at how the other countries are doing. So if the Indian currency depreciates by 10%, but if the other emerging market currencies are depreciating by 14%, then impact is different. So it's a very, very relative one. If you ask my personal view to your question that, what is the impact on IT sector? It is a short-term positive for IT, but in long term, it doesn't make much difference because customer is aware that you as a supplier has got 9% benefit. So customer will definitely ask you to pass on that benefit. How much the company able to pass on? Do they need to pass on 100% or only 60% or 70%? That depends upon individual companies' business models. But in my view, in the medium to long term, we have seen in last 20 years, normally speaking, customers are very, very demanding, and therefore, normally you have to pass through the entire benefit to the customer because you are no more competing based on pricing. You are basically saying that, okay, I'm better in terms of giving you solution, not on price. And that's where, your company gets more market share. So that's our view on currency and its impact on market.
That's good. That's good, Rajesh. In fact, another question was from Mr. Ajoy. What is your view on the current EV push in India?
Well, I think EV push will continue globally, and therefore India will also participate in it. Government will do whatever is best possible from the EV perspective, but it is going to be a phase by phase approach. So for two-wheelers, it will be the fastest, then three-wheelers, then passenger vehicles, then buses, and then trucks. So for two-wheeler industry, maybe over next 5 years, 30% penetration by EV likely. For passenger vehicles, it may not be EV, it might be hybrid. You are already seeing the models of Suzuki, correct? So I think hybrid probably will be more successful in India compared to just EV, because EV also has its own challenges. And for trucks, it may take another 6, 7, 8, 9 years to go to the EV as a majority of vehicle become EV. That is a longer time for commercial vehicle. So net, if you ask me from the equity market perspective, because I think all your questions are finally into equity market, how to play EV? In my view, you need to focus then on auto ancillary companies. First, you avoid the companies which get disrupted by EV. So for example, if you look at the OE space, say two-wheelers, instead of 4 players market, all of a sudden it will become 10 players market. Not good for two-wheeler OE players, because 4 players are becoming 10 players. So they need to roll up their sleeves, they need to be efficient. But for the auto ancillary companies who are catering to the EV side will benefit in a big way. And companies who are typically IC engine side, over a longer time, their business will be severely impacted. So you need to make the 2 buckets within auto ancillary. One bucket, the company may not exist after 10 years. And another bucket, company may grow 10 times in 10 years. So you need to be on the right side of the tree.
That's very apt, Rajesh. Another question from Mr. Bajrang Singh. What is your view on future of earnings of December closing quarter and March 23 closing quarter? Are you seeing earnings pressure?
Okay. I think if you ask my personal view, the earnings growth is going to remain double digit for India. I don't see that as a challenge. Corporate earnings growth in FY23 will be roughly about 12% or so. In FY24, likely to be 12 to 15 to 16% or so. So double digit earnings growth will continue. Let me put, however, one important disclaimer here. In a Nifty earnings particularly, you also have commodity companies and their weightages are very high. 12% of the index, 20% of the index, 30% of the index. And those commodity prices are on a down cycle. So commodity prices can puncture your reported earnings, but don't look into that. At times, you will basically miss the forest for the trees. So what is important is look at the companies where we need to focus on. And those set of companies, for example, our portfolio companies, they are growing by 20% plus. So beyond a point, I don't look much, what is the Nifty EPS. Broadly, it will do double digit. But when I look at my portfolio companies, I think they will grow at probably 20% plus for FY23 as well as FY24.
That's good, Rajesh. In fact, the next question is about AAA emerging giants. In fact, AAA emerging giants doing so well and beating the benchmark by huge margins and topping the charts. Thanks, sir. In fact, thanks for this statement. Can you please throw some light on the secret recipe of the same?
Okay. Well, AAA emerging giants, as most of you might be aware, it is nothing but a 50 stocks portfolio in a mid cap and small cap space. But let me tell you one thing, we do not look at actually companies based on just market cap. For us, it is very important to look at the companies from profit size perspective. And moment you differentiate these two, you actually can, make difference between water and the milk. Our entire portfolio in AAA emerging giants, they all are large companies. They all are market leaders. We do not have actually any small company or mid company in our portfolio by profit size. For example, let me give one example. In plywood, the largest company is called Century Plywood. And Century Plywood is considered as a small cap because the rank of this company in market cap is beyond 250 by the regulator. But is the company small? Answer is no. Company is not small. Or for example, let me give another example, Timken. Top 3 companies in the bearings in the world and top 3 companies in India. But as per regulator, it is a small cap. But is the company small? No, company is not small. Is one of the topmost company backed by R&D and zero debt balance sheet and 20% ROE. For example, in luggage, we own one company called Safari. There are only 2 players, VIP and Safari. Both these companies are small cap as per market cap definition, but companies are not small. So what we have done is that in AAA emerging giants, all our ethos, protect capital, create wealth, our ethos of investing only into sectoral leaders, irrespective of its market cap, backed by the big profit size, very important, and zero debt balance sheet, and strong return on net worth. That's the 3 important characters we always look at when we buy any company. And our triple emerging giants is also following the similar approach. And because it is focusing on the right side of the earnings growth, the performance has been quite satisfactory. We are reasonably, what I would say, satisfied with our triple emerging giant. The entire purpose of the launch of in the product is, we are able to meet that objective, and that's what makes us as well happy. And this comment also makes us a little bit more happy. So thanks for that.
Yeah, thank you, Rajesh, and thanks, sir, in fact, for this commenting statement. In fact, one question on the global. In fact, our director, Mr. Govind Agrawal, also on the call. For the US Fed is expected to raise interest rate again by 75 to 100 basis points. That can surely have a negative impact on US equity markets. In that context, what is your view on Indian equity market for next 3 to 6 months? This is a short-term one. I request this, Govind sir, please take this.
Sure. Thank you, Sandeep, and for asking this question. So while we are no experts on US and global markets, but whatever limited understanding we have, I will just convey that. So if you look at the chain of events, Rajesh has already covered most of it. What has caused the inflation? Because for higher interest rate of 300 pips in 6 months' time, the underlying reason has been very high inflation. And what caused that inflation? This was the commodity and the supply chain issue. Rajesh also showed you the numbers, how those prices have corrected by 20, 30, 40, and even in global supply chain index, it is down by almost 60% from the peak. If underlying commodity prices and underlying cost has been down so much, the inflation in the second half of 2023 is expected to be significantly lower. In fact, Fed itself is talking about close to 3% towards the end of 23. And if the prices of these commodities remain around these levels, maybe we will see very low single-digit inflation starting second half of 2023. In US, if you see, the inflation high base started from October 2021, and from next month onwards, if the prices do not move up further from here, then the inflation should start to fall. So the inflation is falling, the interest rate cannot keep rising from significantly from here. So while everyone is expecting interest rates to be 4 to 4.5%, and market moves much ahead of that. Market discounts those events much ahead of that, and the prior incidents are clear indicators of that. Let me quote you two such examples. In 2005 and 2004 and 2006, the interest rate went up by almost 400 bits, and during that 2-year period, Nifty gave return of 95%. Then 2015 to 2018, interest rates again moved up from practically 0 to 2.5%, and Nifty gave return of 36%. So what causes that return despite significant increase in the interest rate there? it is the underlying earnings growth. And if underlying earnings growth in Indian equity market is around double digit, as Rajesh gave you many drivers for those earnings growth, then I think there could be temporary dip in the market, because if heavy selling comes, market do fall. I mean, whether it's good, bad, everything falls. But as the normalcy returns, the market starts to find its own level. So while there could be some near-term impact or knee-jerk reaction, but underlying market earnings growth are strong, valuations are becoming quite reasonable, so we do not expect a significant impact on the market.
Thanks, Govinji. The other question from Janvi Bhansali. Any company this, I think this is for Rajesh. Any company you like in defense manufacturing sector?
Yeah, we have been very, very selective on this theme. Yes, there is a Make in India effort by government, and it is going to create a huge opportunity for the defense sector. But one need to remember that most of these companies in this space are either unlisted or they are public sector companies. So you need to play this theme very, very carefully. Most of the times the stories are big, the numbers are big, but it takes these all are long gestation projects. At times they are 20 years projects, because once you get the pilot project to develop it, it takes 3 years. Then they have to test it. For example, I remember one of my company in 2005-6, I used to meet them regularly for the defense. And every time it used to get tested in Rajasthan, desert, then it get tested on Kashmir, Ladakh, and then northeast border. And at times the product fails because it's extreme weather conditions. So it's a really long gestation project. So you need to be really very, very selective. So yes, we have very selective exposure in this sector, but that's just one company in our portfolio, nothing beyond that.
Okay, that's good, sir. In fact, one more question. Vibhuti ma'am, how would Indian equity perform in next year or two amid global risk of sentiments and quantitative tightening, even if earning growth remains strong?
So I think, just now my colleague, Govind has already answered it in very, very detail that yes, there are global headwinds, no doubt about it. Question is, how much of that headwinds are already priced in? And your guess might be as good as mine, but important is, this is not a new news to us. It's not new. Everybody's talking about it. To some extent, it is priced in. To some extent, it may not be. Can market go down by 5, 10, 15%? Anytime in equity market, these are called normal corrections. It makes market healthy. But as I've discussed at length, and as my colleague Govind is also just now mentioned, please remember, the earnings have gone up and the markets have not gone up. So to that extent, you are already getting it at a discount. Can this trend continue forever? Definitely not. Correct? It's not possible that 100 will become 150 rupees EPS and 150 will become 200 rupees EPS and market will remain 100. Just not possible. And if it remains 100, then in 1 year it will go up 100%, because finally 100 has to become 200. So I think, we need to focus on the companies, keep a little bit longer term view. The corrections are normal in equity market. Volatility will remain high. Accept the volatility. Take it to you as a friend. If you are conservative, do staggered approach. If you are not too much bothered about day-to-day market movements, not bothered about next 2-3 months movements, looking for 3 to 5 years time horizon, then invest based on today's prices. That's how equity market works in a normal market.
Thanks, Rajesh. One more question from Mr. Ramesh Sadhwani. Rajesh, can you please clarify India's market share versus China in specialty chemical segment? Is it 15% or 35%? I believe he's referring to the slide.
Yeah. Okay. What I said is, India is right now 33% of Chinese market. That's it. Our share in the world market is extremely low. We are 1/3 share compared to China. So opportunity, China is huge. And I never say it is China versus India. Not possible. China's scale is at a significantly high level. Even if there is a 5% shift from China to India, that's a huge opportunity for us, correct? And we are seeing on ground the signs of that happening. So I think it is not 33 or 15. It is total pie of China. Let's assume it is 100. Then right now, what is India's size relative to that 100 is only 15 of that 100. And that's where the opportunity is very large.
Okay, thanks, Raj. And maybe one more question. In fact, you talked about defined exit strategy. Can you please elaborate on it?
Okay. Well, as I said, I think everybody knows probably what to buy. But where most of the investors go wrong is when to sell. Discipline exit strategy is something most critical if you finally want to make money in equity market. What we have done is that we have a very scientific approach to that exit strategy. We exit under three circumstances. One, the portfolio rebalancing. If the weightage is cross a particular level of the company or the sector, then we reduce that weightage. Second is we sell when our target valuations are met. So if the company reaches our target valuation and if it is no more attractive, then we get out of it. And third, we exit when we believe that our thesis is not working as per what we thought. And that's very important. And it is that kind of a, what I would say, agility, which allows us to make sure that our portfolios are always aligned. Let me show you one important slide if it is here. Give me one moment, please. So why exit is important, and this is important slide. 75% of Sensex has changed in last 16 years. All these companies, what you see here, they all were part of Sensex. ACC, Bajaj Holding, Castrol, Glaxopharma, MTNL, Reliance Communications, Sterlite, Jaiprakash, Reliance Infra, Reliance Petrol, DLF, all they are part of Sensex earlier. Today, they are no more part of Sensex. Correct? And many of the stock prices, they are down 60, 70, 80, 90% from the peak prices. So blue can become red at any point of time. And that's how the exit strategy is something very, very critical. And because that exit strategy is critical, you need to, as I say, this is the mechanism by which we follow the discipline exit strategy. We make sure that the portfolio is always focused towards the earnings growth. And for example, if I show you this chart, very important chart. This is FY22 inner circle and outer circle is FY23. This is a nifty incremental profit from where the number is coming. Okay. So this is nifty incremental profit 22, outer circle is 23. If you look at this very carefully, the yellow color is missing in outer circle. The yellow color is metals. So of the nifty incremental profit, it contributed 32% in FY22, but it is going to contribute 0% in FY23. Very important. And look at this blue color. This blue color is missing in FY22. Can you see here? 38% automobile in FY23 of the incremental nifty profit, it has contributed 0 in FY22. So the only constant is change. And therefore, we are positioned for the companies and the sectoral weightages where there is a earnings growth. So if you believe that the auto is not going to deliver, say for example in FY25, just give me an example. Probably we will get out of the entire auto sector probably little, much ahead of the time, and that's how we implement the exit strategy.
That's good. Just one more question. In fact, it's on the market. In this volatile time, how one should invest, lump sum or staggered? Your take.
I think every investor has different, risk return profile. Every investor has different allocations. It is best that they check with their wealth managers what is the best suitable to them. If you are worried about daily price movements, if you are really very conservative, you can do stagger your investment over maybe 3, 4, 5 months. Don't wait beyond a point. There are many people, they are just sitting on fence from last 2 years and they could not do anything and they missed the entire opportunity. But if you are not worried about that thing, and if you know that, okay, I have a 5 years view, and in 5 years, my 100 can the potential to become 150 or 160 or 170. So what if 100 becomes 95 in between? That's fine. That's part of life. That's part of the game. Then you invest today. Then don't wait. So, that's my honest answer to this question, lump sum versus stagger.
Thanks, Rajesh. In fact, AAA also, I'd like to add something. In fact, AAA Alpha Accurate Advisor also provides the facility of SIP as well as STP. One can invest in a liquid strategy, and from there one can look for STP for next 3 to 6 months if he can opt for that. The next question, in fact, about again the global, I think many commodities prices have started correcting, as you have also shown in your one of your slide. So inflation is likely to cool down. Do you agree? And if yes, when we will see the impact of that lower inflation? I believe Govind sir, please.
Yeah. Sandeep, I think I have covered this answer in my previous covered this question in the previous answer, but just to reiterate, if you look at the US inflation, because the whole world is looking at the US, the inflation in US from October 2021 was 6.2%. And from 6.2%, it kept rising to 9%, and currently it is around 8.5%. Now, from October to right this next 11-12 months, the inflation has been 7, 8, 9%. And but if you look at the prices which Rajesh showed in that chart, the prices, the underlying variables, what caused the inflation, most of them, I'm saying most of them, some of them are still not corrected. For example, real estate has still not corrected much in US while the correction has taken. Most of them are down significantly from their peak prices. So, from those peak prices, the inflation of 8-9% from March, April, May, June, and September, October, inflation because of very high base effect, and two, because of the significant fall in the prices, inflation is expected to be low single digit. So if inflation is low single digit, will the interest rates which are now, or the 10-year G-Sec yields which are closer to 4%, will it remain there? Probably answer is probably no. And also, if you see the statement from the Federal Reserve governors, they're also talking about interest rates moving down from the second half of next year. So I think the bulk of that negative news, as Rajesh also mentioned, is already priced in. And as inflation starts to fall, market will take cognizance of it. Let me also give you one more point. The high interest rate, which is now closer to 4%. Now, who gets impacted more? It's the largest borrower. And who is the largest borrower? The government of US, or globally, the governments are the largest borrower. If the interest rates sustain at those levels of 4% or so, the government is the biggest loser. And most such governments are not in a position to raise the taxes. And that is where they first want to kill the inflation so that the interest rates also fall. And that is exactly what the Fed Reserve is doing over there. So, just to summarize, we expect the inflation in US to start declining from next 2-3 months onwards, and maybe from second quarter next calendar, probably one should see the interest rates also falling.
Thanks, Govind sir. In fact, just now one question came in chat box. So while most of the high frequency indicators still about few months showed positive growth, what is your view on IIP of August, which contracted for the first time after any months, and few other indicators which are showing some moderation? Do you see any threat of earnings downgrade going ahead?
Rajesh, you will take up this?
Yeah. Good question. So I think what is going to happen is when you look at any data, you would always see some positive data and some negative data. And you need to, take the combined data and interpret that, because the month-on-month volatility will be always there. In some data will show you very good sign, and some data will show you not that great sign. So I think the industry growth is to certain extent impacted, and of course you have a breakup of what is getting impacted, so on and so forth. Normally speaking, September and October months are the festive months for India. And in September and October, normally that decides actually the overall Indian economy, because these are really bulky consumption months. And particularly the month of October, September and in October, we have Dussehra and Diwali. These are both coming together in a single month. So I think important to see would be how is the September month, particularly because most production happens in September and gets to the inventory level, so that consumers gets satisfied, with their demand in the month of October. So I will not read too much in August. Also, August is a seasonal month, a little bit lean. At times there are, बारिश ज्यादा होता है, flood होता है, कहीं पे supply की तकलीफ होती है, और ये every year होता है. मैंने देखा हुआ है, every year, particularly either in July or August or first 10 days of September, some or other parts of the countries are impacted because of the supply chain bottlenecks, because of the excess rain and so on and so forth. So I will not read too much into that number. I will go by the GST collection, which is strong. I will go by e-way bill number, which is strong. I will go by the overall electricity, which is reasonable. And last but not least, don't read too much. As I said, I don't want to become economist. Very important how these 100, 200 companies are going to do and what they are doing. As I said, there is a pain in the rural side. No doubt about it. There is a pain in rural economy, SME segment. Also, there might be some pain in SME segment because they are also getting impacted. They are not getting raw material on time. Raw material price is going up and down. So they get a little bit more volatility. Is not good for any SME sector. They might be under pain. But if you look at the corporate India, the listed space, and of that 100, think of it. To this person who has asked me this question, I will remind him to think of a company like Trent, and I gave an example. So much has happened in economy. So many IIP number came and gone, but company has doubled its size in 4 years. That's a fact. There is a company called SRF, Specialty Chemical. The revenue of this company was only 800 crores in FY18, and today the Specialty Chemical is 3,200 crores, 4 times in 4 years. The GDP growth is only 6%. And there are so many such companies. Minda Industry company grew 10 times in 10 years. 10 times in 10 years. What are we talking? Correct? You look at a company like Tinkan, the export growth for 3 years is 18% compound. Irrespective of your global GDP, exports, people should look at GDP global. What is global GDP growth? 1%, 2%, 2.5%. That's it. But Tinkan grew by 17%. तो क्या होता है ना, बहुत ज्यादा macro analyze करके you don't get your wealth creation. Much returns are made by looking at the companies, looking at the specific approaches, and of course keep the macro in background. That okay, there might be slowdown. World is going to enter into recession. Some slowdown is likely in India. You cannot skip the entire thing. You cannot say, I'm not into that camp that India is decoupled. Nothing can be decoupled. Everything is coupled. But the impact is getting reduced because of the right reasons. And importantly, how is our portfolio is positioned? Are we going to get it right? And let me give a classic example. If you say that there is a recession, which will be the biggest economy will be impacted? US. And if US is going to get impacted, which sector will be impacted most? The companies who are catering to that US. So software is the biggest sector to be impacted. We have reduced our software sector weightage in month of March from 13% to almost 8% or 7.5%. I'm talking about early March. And of course, stocks from that level is around 40%. So you need to be very, very agile. You just can't say everything is good and we'll keep holding the thing. Life doesn't work like that. IT is going to be impacted because US companies are going to be under slowdown. There are warnings coming from US companies, and therefore IT is likely to be impacted. There is one question I can see on panel. Please share your view on IT. And our view on IT, you should have actually seen our portfolio in March. We have half the weightage in IT. And we still believe that the sector will continue to have some pain, probably for another 3, 4, 5 quarters. So just answering both the questions together. Beyond a point, we don't focus too much on macro. We focus on sectors, focus on companies. There will be impact somewhere. Make sure you don't get impacted. Make sure we are not into that part of the portfolio which will get impacted because of recession, because of slowdown, because of the high interest rate. What is the today biggest risk? Interest rate going up. Look at my portfolio across mid cap, small cap, focus, IOP. All our portfolio companies are 95% of the portfolio companies are debt free. They have a zero debt. So if the interest rate goes up, they are not going to get impacted. Correct? If the US market slows down in a big way, my IT weightage is already reduced. I don't have any exposure to apparel companies who are exporting to US. So you need to be constructive and structure your portfolio in such a way that drawdown or the impact, the adverse impact is limited to your portfolio.
Thanks, Rajesh. That's almost the questions also dried up now. And yeah, just want to announce one thing. Many people posted that they want a recording of this webinar and all. So this recording will be available on our website as well as our YouTube channel. You can, and we'll share there as well on our LinkedIn as well.
We will also send through an email to all of us.
Yeah, we can send through the email as well. Just write a line and we'll revert on with that. That's not. Thanks you all our esteemed partner for your time and much more means interactive and questions and all. It's really encouraging for us, and we'll definitely request your feedback. It will always encouraging for us. Whatever we can add, what we can, what you like, we to come up with. Please feel free to share all your humble feedback. With this, thanks you all. Thanks Rajesh, thanks Govindji. With this, closing the call. Thank you.
Thank you, friends, and wish you.
Thank you all. Thank you for the participation.